Mr. Srinivas, Chairman SBI, Mr. M.A. Rao, Chairman IBA, and Mr. B.K. Das, CEO IIBF, and ladies and gentlemen, good evening to you all. It is really my privilege and also I am delighted to deliver the 14th R.K. Talwar Memorial Lecture honoring the great legacy of late Shri R.K. Talwar ji. He was truly an extraordinary leader of the banking industry, respected for his integrity, vision and service. His contribution to the banking industry and his accomplishments go beyond his life of honesty, truthfulness and courage. I am really honored for being invited by IIBF to deliver the lecture this year. Now, coming to the present times, where developments across economies are happening at breakneck speed, India is embarking on an ambitious journey of Viksit Bharat. It is pertinent to talk about the visions of Viksit Bharat and the onus of realizing which lies with our financial sector led by banking in creating a strong economic country, promoting sustainable and inclusive growth, touching lives of all the people. In this journey, I invite you all to contribute to achieve the reality of a robust and inclusive Viksit Bharat. While analyzing the endeavors of our banking sector, I will also like to focus on the role of regulations, enabling a responsible yet frictionless pace of progress toward this ambitious mission. The global economy is on a roller coaster ride. According to the IMF's World Economic Outlook, January 2025, the global growth is projected to be 3.3% for both 2025 as well as 2026, which is below the historical average of 3.7 during the last 20 years. While the US economy continues to show strength, Eurozone, as you all know, is grappling with stagnation. While inflation is expected to moderate, uncertainties and risks, including those arising from geopolitical tensions, trade protectionism, inward-looking strategies, and policy ambiguities continue to loom large over the world economic horizon. The challenging global economic landscape is further complicated by the strong dollar, which strains emerging market currencies and heightens financial market volatility. Prolonged geopolitical conflicts, geoeconomic fragmentations, inward-looking policies, renewed trade protectionism, competitive retaliation and emergence of trade war have created plenty of uncertainties in the global policy arena. India's growth, though not fully insulated from these vagaries, is driven by strong domestic fundamentals and much-needed sustainable reforms. Indian economy is ranked 10th largest in the world in 2014, has risen to become the world's 5th largest economy by nominal GDP and the 3rd in terms of purchasing power parity today. Indian economy maintains its status as the world's fastest growing major economy and is expected to improve its position in coming years. The well-coordinated fiscal and monetary policies, in combination with the structural reforms in the last few years, have enabled building business-friendly climate and has become home to the numerous global innovative firms. Thanks to a confluence of factors, including the steps taken by the government, the Indian economy has emerged as the bright spot of stability and opportunity. We have not only kept our house in order against large and overlapping global shocks, but also improved our macroeconomic fundamentals and safety buffers. The balance sheets of banks and corporates are the healthiest in a long time, and with the public investment pushed by the government, have created favorable conditions for a sustainable revival in investment and growth. Consumer confidence, which showed some signs of moderation in the last couple of quarters, will certainly revive by the demand augmenting measures announced by the Honorable Finance Minister in the latest budget 25-26. As evident from surveys, revival in consumer demand both in rural and urban areas is on a rising trajectory. Our external sector inspires confidence as we are reaping export opportunities in this service sector. Our current account deficit remains eminently manageable, and we have bolstered our forest reserves with a 10+ months of import cover to deal with any potential adverse eventualities. The large domestic consumption base of India, constituting nearly 60-65% of the GDP, helps India to insulate itself from global slowdown. With India's 1.43 billion population, with a median age of 28.2 years, 68% of the population belong to the working age group. This helps the nation to enjoy demographic dividend, and India is well poised to take advantage of this. Today, India has become the new global growth engine with its young demography, improved physical and digital infrastructure, and above all, an enabling policy environment. Viksit Bharat 2047 is the vision to transform India into a developed nation by 2047, the centenary of India's independence. The vision encompasses developments across various segments of Indian economy so that they rise from the current state to drive the agenda set by the Honorable Prime Minister vision. Our aspirations for Viksit Bharat 2047 aims to strive for India's GDP to be $30 trillion from current $3.89 trillion, per capita income $18,000 to 20,000 from the current levels of 2,700, and bank credit to prevent private non-financial sector as percentage of GDP to be 130% from the current levels of 56%, and achieving 100% financial literacy and many more other targets. Given the importance of banking system in supporting economic growth, the constraints the sector faces need to be addressed well in time so that the banking sector accelerate the wheels of Viksit Bharat mission. The first and foremost constraint of Indian banks is of having a strong capital base to support the Viksit Bharat mission, and for which our banks would need to raise significant amount of capital to support the country's economic growth. Hence, access to capital from all sources, including international sources, need to be looked at and to be worked upon. The second challenge is ensuring universal financial inclusion and involvement of the unbanked. Banks need to create opportunities for every individual to grow and contribute to the nation's progress. This involves innovating and reimagining banking strategies to align with the evolving needs and preferences of customers. India needs to achieve 100% financial inclusion from current levels of 64%. We need to work on developing more simplified micro investment products, financial awareness regarding financial products, digital transactions, and other government schemes in rural and remote areas need to be accelerated. Also, the existing gender gap, not just with respect to deposit account ownership, but also with regards to access to credit, needs to be overcome. Expanding social security net is important through universal insurance and pension coverage. India's share in global premium is about 2%. Production gap in India is 87%. Given the very low insurance penetration of 3.7 in 23-24 in India against a global average of 7%, banks need to support the people to access social security net for the masters by financial literacy and product customization. Large banks provide financing for large-scale projects, supporting massive infrastructure development requirement, driving economic growth and development. Large banks also play a crucial role in stability and growth of the global economy, as the resources and expertise to absorb shocks and manage risk better, ensuring stability in the financial system. From innovation angle, large banks are also preferred as they invest in financial technologies, promoting innovation, which lead to more efficient and accessible financial services. Moreover, large banks ensures that both businesses and individuals have access to reliable and efficient financial services, as intermediation costs for bank decline and makes them efficient. Apart from the above, universal credit coverage for MSMEs and agriculture is a must. Given the MSME sector contributes to 30% of India's GDP, and 40% to exports and 60% to employment, we need to have robust credit flow to the agriculture sector and enabling the access to credit for the MSME sector and supporting entrepreneurship and generation of employment. Advancing digital capabilities and future competencies is also very important. The banking sector needs to harness the full potential of its workforce using digitization and emerging technologies like generative AI. Moreover, building a strong banking system that enhances global confidence in India's economy is important. This will attract more foreign investment and support country's economic ambitions. Our aspirations of Viksit Bharat need a strong base to be laid by the current incumbents and leaders, and subsequently to be driven by coming generations. Having said that, we need to reflect on our current strength that can be leveraged and the emerging challenges that need to be addressed. The aspirations require systematic changes, institutional reforms, and regulatory overhauling. Viksit Bharat mission reckons banks to deliver on certain structural themes. To begin with, mobilizing deposits on permanent basis may be a top priority. This is because households are turning net borrowers from the banking industry, aggravating pressure on the margins and liquidity. Enhancing productivity is also important, as it's seen that over the past decade, costs have risen faster than income. Productivity gains have lagged cost increases. As tech and compliance costs are expected to be higher in coming days, banks need to deploy innovative solutions to boost income. Building future-ready capacity by fully embracing future capabilities such as operation, tech resilience, ESG, AI, and Gen AI is vital to all the banks. We need multiple globally competitive large banks having presence across the globe, facilitating access to global funds, best talent, and technical expertise. Currently, only 2 Indian banks, SBI and HDFC, feature in the top 100 global banks by total assets, which is not enough in comparison to banks from China and US, which dominate the top 10 global bank list. The current banking conglomerates need to expand horizon, extend operations into global financial hubs, utilize green bonds and sustainability-linked loans and foreign debt markets to fund domestic credit expansion. This size and scale would enable these transformed banks to become global, to fund large projects spanning across infrastructure and manufacturing, entailing setting up peripheral industries and projects, thereby creating and catalyzing job creation and urbanization. MSME is another segment which, despite the best efforts of all stakeholders, continue to rely on funds outside the formal banking channels. Multiple institutional reforms have been undertaken during the last 5 years, including the Union Budget of 25-26, that increase investment and turnover limits of MSMEs, expanded credit guarantees facilities, schemes for dedicated support for first-time entrepreneurs, etc. This may minimize the formal credit gap to the sector. Lending institutions need to leverage digital public infrastructure, unified lending interface to expedite assessment and disbursement. However, the most important step is to handhold and support the MSMEs, which entails setting up comprehensive support ecosystem that include mentorship, financial literacy programs, and advisory services to empower in managing finances and making informed decisions. The new credit assessment method, wherein a few public sector banks have developed in-house tech capabilities to assess MSMEs using digital footprints instead of external assessment, aims to provide a more accurate evaluation and improve MSMEs' access to credit. The National Infrastructure Pipeline proposed an estimated expenditure of 165 lakh crore over the next 5 years. With an envisaged debt equity funding of 70-30, NIP would require about 120 lakh crore of debt. The niche sectors like semiconductor require huge funding to set up whole ecosystem. Financial sector needs to play a major role to make NIP a reality and provide funds towards capital-intensive sectors. While financing a capex and project is vital, it is also equally important that small ticket loans for employment generation grow even faster, furthering our financial inclusion and unlocking our productive potential of citizens is a national priority and also a moral imperative. Schemes such as Prime Minister Jan Dhan Yojana, PMSBY, PMJGBY, PM Swanidhi, PM Vishwakarma, PM Mudra, etc. have contributed significantly in deepening the financial inclusion in the country. However, we need to do more. Digital payment system and fintech will play a vital role in transforming the current state of economy. The digital transactions in India have grown over 90-fold during 13 to 24, constituting 99% of total payments in financial year 24. On the other hand, India is the third largest fintech sector in the world, with more than 13,000 fintech companies and a cumulative investment of more than 33 billion. These are testaments of India's growing capital in digital prowess and also conducive policies and infrastructure in place. However, the future steps and initiatives would be more crucial than ever. We need to build a resilient policy and regulatory framework for fintech, putting in place information repository, regulatory framework for fintech, digital payments intelligence platform to mitigate digital payment related frauds. While strategic collaboration between banks and fintechs have led to several innovations in the sector ranging from better customer service to last mile credit delivery, it also calls for adequate safeguards to protect the digital infrastructure of institutions and customer endpoints. Banks are expanding the skill development centers for a hand-holding and providing technical training, setting up more SHGs across the country and imparting financial education and disseminating initial credit. Other stakeholders also need to pitch in to utilize their CSR funds to provide all the basic support to these vulnerable segments, to uplift them from their current standing so that they become part of mainstream economy and actively contribute to the development. The relentless reforms and substantial investments in the banks over the past few years have brought the banks to a position of strength, whereby they have a strong capital base, providing with loss absorbing buffers. Credit growth is broad-based and is in double digit for the last 2 years. To meet the growing credit demand, banks are raising capital from alternate revenues, including capital market, long-term bonds, CD issuance, as well as through competitive deposit rates and drawing down their high-quality liquid assets. Today, Indian banking system continues to be resilient, backed by improved asset quality, stable and broad-based credit growth, and robust earnings growth. To reach and depth of financial information is being aided by technology and growing digitization, which provides new opportunities for growth and financial inclusion. Tech innovations in the financial sector have improved credit delivery mechanisms, improving the scope for further innovation in banking and financial products and furthering differentiated banking needs. The recent measures taken by the government on digitization of economy and availability data provide a more objective and comprehensive basis for credit assessment and thereby enhance lending to both individuals as well as businesses. To sum up, Indian banking is well paced to support and accelerate economic growth for a Viksit Bharat. As reforms are an ongoing effort, the regulator and government have aligned to promote growth support to reforms with adequate safeguards. In this context, the role of regulations in spurring innovations and ensuring financial stability is critical, which is an age-old debate, and I shall try to delve into some details in this part of my speech. Regulation introduces both monetary and opportunity costs, requiring businesses to allocate funds to ensure compliance and often resulting in missed entrepreneurial opportunities. Hence, regulation needs careful evaluation to ensure they achieve their goals and objectives at the lowest possible cost without stifling creativity, innovation, or healthy market dynamics. Simultaneously, an emphasis on innovation and competition without proper safeguards can lead to financial instability and resource misallocation and erosion of trust in the system. The financial sector and its regulatory landscape are evolving rapidly, with emerging risks arising from new age financial instruments and increased use of technology. The regulators in advanced economies provide assessment of compliance costs versus the intended benefits along with clear and definitive timelines to ensure an informed decision-making in regulatory environment in a transparent and efficient manner. While ensuring stability of financial system remains the primary responsibility of regulatory framework, it is equally important to evaluate regulatory measures in terms of the associated costs and, and intended benefits. Robust compliance structure requires transparency in assessment and disclosure of compliance costs with a definitive implementation timelines. As India's financial structure continues to expand, it is essential to ensure that the cost of compliance is commensurate with the intended benefits. We need to be mindful of the 5-pillar strategy of regulation: forward-looking and productive, nimble, data-driven and impact assessment-oriented, consultative approach, and collaboration with the stakeholders. Balancing regulatory quality is crucial for India's vast and diverse economy, its growing aspirations for Viksit Bharat, and the significant investment required to sustain high growth and development. Globally, 5 criteria are used to evaluate regulatory quality in an economy: democratic legitimacy, regulatory accountability, fair and accessible procedures, expertise, and efficiency. Since 2014, India has accelerated its regulatory reforms, simplifying taxation laws, rationalizing labor regulations, and decriminalizing business laws to improve global competitiveness through grassroots level structural changes. Regulation must consistently strive to find this equilibrium, implementing the reforms to maintain a balance that fosters growth while safeguarding the economy. As banks are entrusted with the responsibility of serving society with sensitivity and inclusivity, they must always consider the needs of the people they serve, especially the vulnerable sections of the society. Banks as well as bankers need to strengthen the inherent trust and integrity quotient of the general public. As trust bearers of society, our approach needs to be ethical, inclusive, responsible, and also prudent. To keep pace with the guardrails of safety in the ever-evolving dynamic banking landscape, adopting and adapting right amount of regulation is crucial. It is well understood that banking regulation relies on pre-specified, time-tested, and globally adopted toolkits like Basel Accords, which indeed play a crucial role in shaping global banking regulations, much like a guiding test. These accords, established by the Basel Committee on Banking Supervision, provide comprehensive guidelines for banks to manage risk and ensure financial stability. Their standards such as Basel I, Basel II, and Basel III have been instrumental in promoting sound risk management practices and maintaining confidence in the financial system worldwide. In a rapidly evolving financial system, over-reliance on existing regulation poses many potential challenges to the financial sector, which are unforeseeable. Over the years, sectoral dynamism has tested all regulations, and every financial crisis offered valuable insights, leading to modifications in these toolkits based on lessons learned. Risk that seemed insignificant yesterday is quickly getting intensified today, posing threats to the stability of the financial system. Take the case of online scamming through digital arrests. The speed at which it spreads and damages the system was never anticipated till it struck us. Therefore, we must remain vigilant and responsive to all financial changes occurring around us. Present and future regulations should adopt a differentiated regulatory mechanism based on the size, complexity, and contribution to the systematic risk. As the interconnectedness, scope of activities, and harmonization of financial intermediation increases, an entity-based regulatory architecture may lead to arbitrage between different entities undertaking similar activities. Therefore, moving forward, regulatory thought should focus on activities as a common framework for future regulations. One-size-fits regulation approach carries a great uncertainty in the current regime. A closer look at a regulatory landscape highlights the core principles upon which it is framed. In the Indian financial sector, the debate between principle-based versus prescriptive regulation centers on the best approach to ensure financial stability while fostering innovation, flexibility, and growth. While principle-based regulations offer a flexible framework that guides behavior through broad principles and objectives, it allows banks to apply these principles in ways that best fit their unique operations and circumstances. This approach encourages innovation, risk management, and also operational practices, as banks have the freedom to determine how to achieve regulatory objectives. The emphasis on achieving desired outcome, such as financial stability and ethical conduct, rather than strictly adhering to detailed roles. However, this flexibility can lead to variability in compliance and enforcement, as banks and regulators may interpret principles differently. In contrast, prescriptive regulations setting specific detailed rules that banks must follow. This approach offers clarity and consistency, making it easier for banks to understand and comply with the regulatory expectations. The predictability of prescriptive regulations allows banks to plan their operations with certainty, reducing ambiguity. However, this approach can stifle innovation, as it may not account for unique situations or evolving financial practices for each bank. Banks may find it challenging to adopt within the confines of strict rules, potentially leading to inefficiencies and missed opportunities for growth. In summary, prescriptive regulation in Indian banking offers clarity, consistency, and predictability, but can be rigid and limit innovation at times. Principle-based regulation, however, provides flexibility and encourages innovation, but may lead to variability in compliance and enforcement. The challenge for regulator is to strike the right balance between these approaches to ensure a stable, efficient, and innovative banking sector that can adapt to the changing market conditions and foster sustainable growth. Each approach has its benefits and is often chosen based on the regulatory environment and the nature of the financial system. The key is finding the right balance between flexibility and consistency to ensure a stable and innovative banking sector. To realize the dream of Viksit Bharat, the most important pillar is actually people. A society that recognizes and rewards integrity, character, and hard work of its people will build a society that is fairer, equitable, and happy. At the end, let me again thank IIBF for organizing this lecture and giving me an opportunity to share my thoughts. And also, I thank all of you for giving me very patient hearing. Thank you so much.
Thank you, sir, for those wonderful insights. Some of the key words, if we are to pick from that lecture: stability, sustainability, inclusivity, access to capital, digital innovations, and balanced regulations. So the key words towards Viksit Bharat.